This presentation is about federal filing status. I want to preface my discussion of filing status and dependency by saying that when you establish taxpayer filing status and dependency, this can be complex. It can also be very simple. For instance, if you have an elderly couple sitting before you um, that is married and they say they want to file jointly, there's nothing more that needs to be done. It's married filing jointly. But that's really about the only part of filing status that is actually very simple. The rest of it can be complex. So you must not rely on your memory when making such determinations. You must use the reference materials provided to you in order to make the correct determination. No one expects you to remember all the details that we are about to discuss. We are in the business of looking things up. There are 5 federal filing statuses. The first is single, then there is married filing jointly, married filing separately, head of household, and qualifying surviving spouse. This last one, qualifying surviving spouse, was previously called qualifying widow or widower. So if you happen to have one of the older qualifying child, qualifying relative resource tools that were handed out to you, you may find on the last page, when you're looking at filing status, you may find that the qualifying widow and widower is one of the filing statuses. That has now been changed. None of the rules have been changed or anything. It's only the name of the filing status has been changed to qualifying surviving spouse. Tax-Aide counselors are responsible for determining the filing status for a taxpayer. We're not, we certainly don't want the taxpayer to tell us what their filing status is, other than maybe telling us that they want to file jointly as a couple. But apart from that, um, we don't want taxpayers to tell us that they're head of household, because they don't really know what head of household means from a tax perspective. Yes, they understand that they feel like they're the head of their household, but that is different than the actual filing status. So we need to look for the filing status that's most advantageous to the taxpayer, the one that's legally allowable, and we have our qualifying child or relative resource tool that you should all have at this point. You also have it electronically in the self-study folder under federal resources. Counselors are not expected to remember filing status details, as I mentioned earlier. So you really need to look these things up and make sure that you have the right filing status, and not be influenced so much by the taxpayer trying to tell you that they're head of household, for instance. Filing status is critical, and it impacts credits, including earned income credit. It also impacts the amount of their tax liability and the deductions allowed. So it's very important that we get it right. To take the importance of filing status a little bit further, there are many tax items affected by filing status. First of all, the necessity to file a tax return. If you look at Pub 4012, the Volunteer Resource Guide, Tab A, Chart A, you'll see that filing status plays a role there in their necessity to actually file in the first place. The standard deduction is influenced by filing status. And then you can look at the Volunteer Resource Guide 4012, Tab F, to look into more detail on that. Your tax rate bracket as a taxpayer is influenced by your filing status. Your eligibility for certain credits, for example, the EIC, Earned Income Credit, if you look at Tab I of the 4012, your general eligibility rules, step number 3. So if you look at those things, they all depend heavily on having the correct filing status determined. Let's now take a look at how filing status affects the overall tax rate that a taxpayer pays. on their tax return. So here's a chart that shows the various filing statuses and how they're being taxed relative to those individual filing statuses. So for instance, single filing status, the first $11,600 worth of income is taxed at 10%. Then after that, from $11,601 to $47,150, that amount of income is taxed at 12%. Then anything over that 47,150 is taxed at 22%. So you can see that for each filing status, there's a difference in how their income is taxed. Married filing jointly, for instance, is essentially double what the single tax rate is. So the first 23,200 is taxed at 10%. From 23,201 to 94,300 is taxed at 12%. And then above that, taxed at 22%. And then married filing separate is the same as single, as it should be. And head of household is a little bit different, so they have a different setup. $16,550. The first $16,550 is taxed at 10%. Then from $16,551 to $63,100. That they're in the 12% bracket at that point, and then they move to the 22% bracket. So you can see that overall, on average, they do not pay either the 10%, the 12%, or the 22%. On average, they're going to pay something fairly low, actually. So the kind of people we deal with typically would have probably an effective tax rate of maybe 4%, 5%, or even 6%. But certainly they're not paying 10% on all of their income, or they're not paying 12% or 22% on all of their income. It's an average. So as I said, typically 4, 5, 6% is what a taxpayer effectively pays. So there are a number of things that need to be considered when determining a taxpayer's filing status. Essentially, all of the things that revolve around their living situation. So some of the questions you need to consider are what's the marital status as of December 31st for the taxpayer? Are any individuals living in the home with the taxpayer? Is the taxpayer providing over half the support of any individuals living in the home? Is the taxpayer providing over half the cost of maintaining the home for any qualified individuals that may live in the home, which would qualify them for the head of household filing status? Is the spouse deceased? What's the date of death? Any qualifying children living in the home? So you really need to get these questions answered, and the best way to do that is to use the resource tool that we've provided to you, because as you go through the flow chart on page 8 for filing status, you'll be asking all of those questions. So as you get the answers, it determines where you go down the flow chart and determines where you're going to end up as far as a filing status. Let's talk about marital status in the United States in the federal tax code. Marital status is determined on December 31st of each year. So whatever the marital status is on that day, December 31st, determines the marital status for the entire year. The federal definition of being married in the United States, the legal marriage under laws of the state or the country. So if you're legally married in a particular state, you're considered legally married at the federal level. It does not include civil unions or registered domestic partners. When we say United States, we're also talking about the District of Columbia and any U.S. territories such as Puerto Rico. There's no requirement for taxpayers to substantiate their marriage. We simply take their word for it. So if they tell us that they're married, we accept that and we go ahead and we do their tax returns accordingly. Slide, we can see the part of the intake booklet actually on the first page, page 1, about 2/3 of the way down. you'll see a section as of December 31st, 2024, was your marital status, and you have several choices there. So they're going to check off either never married, divorced, married, legally separated, uh, and there's also a question, if married, were you married for all of 2024? And the answer either yes or no there. And then there's, did you live with your spouse during any part of the last 6 months of 2024? And they would answer yes or no to that question as well. And then if they were widowed, uh, and whatever the year of the spouse's death, there's a place for that. So if they were widowed, they would check that box. So about 2/3 of the way down, we're going to look at that and see how they identified their marital situation. We don't ask them, what is your filing status? Because that's our job to determine that. So we're asking them, what is your marital status? And they're telling us what the marital status is. And then we interpret that into a filing status. On this slide, we have a graphic of the filing status decision tree that appears on page 8 of the qualifying child qualifying resource qualifying relative resource tool that you should all have at this point. You can also find a similar graphic in your volunteer resource guide, publication 4012, on under tab B as in boy. There are also some very well written interview tips on page 9 of tab B. I suggest that you look at those because asking the right questions of the taxpayer is the key to making sure that we get the filing status determination to be correct. So that's also a good thing to do. Also, you'll notice in this decision tree, there are various places where there will be footnotes that will you'll be pointed to those footnotes through these superscripts, like a number 1, number 2, or number 3. If you see one of those superscripts, it's very important that you consult the footnotes to make sure that you understand the entire situation, because mistakes can easily be made, and decisions can be incorrectly made by not by not paying attention to the footnotes. So make sure, please, that you go to those footnotes if, as you go through the decision tree, you see them. Go to the bottom underneath the graph, you will see a list of the various explanations and footnotes that apply to those superscripts. So that's what you see on page 8 of the decision of the resource tool. And now we'll move on to more detail. For head of household filing status, it's necessary to determine whether the taxpayer contributed over half the cost of maintaining the home that was the home of their dependent child. And here we can see on this slide that there is a worksheet that can be found in publication 4012, the Volunteer Resource Guide, under tab B as in boy. And you can see here that for the taxpayer, you can put in their property taxes, their mortgage interest, the rent, utility charges, property insurance, food consumed, other household expenses, and determine the cost of keeping up the home so that you can then take half of that cost. You can also see in the box below that there is a proposed regulation that would make it a little bit easier in that you wouldn't have to take the actual property taxes, mortgage interest, and property insurance. You could just use the market rental value. If you know what the rental value of the taxpayer's property is, or close enough, you could just use that to make that determination instead of having to dig out what they actually paid in property taxes and mortgage interest and that kind of thing. So that's a little tool that you can use for the taxpayer. In some cases, you may not feel comfortable that the resource tool that we've provided to you necessarily gave you the correct answer. You might want to verify by using some other sources. And here are some IRS sources. The first one being the IRS Interactive Tax Assistant. You can go to irs.gov and you can use the ITA Interactive Tax Assistant and can determine filing status using that. Also, there's frequently asked questions on irs.gov related to filing status, and you can use also the publication 4491 training manual and look up filing status in there. So you have various ways of confirming what you've determined by using the resource tool if you find if you feel more comfortable using two sources rather than just one. So let's talk about each filing status independently of each other. We'll start with the single filing status. The first point here is that in order to be single as a filing status, you need to not be married as of December 31st. We need to remember that whatever your marital status is on December 31st is the status that you have all year long. So if you're married on December 31st, you're married all year. So in order to be single, you can't be married on December 31st. The second point here, married but legally separated under a divorce or separate maintenance decree. So you'll get some taxpayers that will come in and say, oh, well, we're separated. And then you ask them if they're legally separated. Oh, yeah. But in fact, they need to have either a divorce decree or a separate maintenance decree issued by a court in order to use that filing status on their tax return. There may be more advantages or more advantageous filing status that could be used for a particular taxpayer. We need to explore those. And a taxpayer may have a qualifying individual that may qualify them for a different tax status. The taxpayer paid over half the cost of maintaining their home, so they may qualify for head of household. They may also qualify if they had a spouse that passed away in the last year. They may qualify for qualified surviving spouse or perhaps head of household. So we need to explore all those things and give them the most advantageous filing status. Married filing jointly filing status. These are people that are considered married on the last day of the year, December 31st, not legally separated or divorced, so they're still married, and it includes common law marriage, both Rhode Island and New Hampshire. It may also include a situation where the spouse may have died during the current year, tax year, and that the taxpayer has not remarried. So those people would also be filing jointly, even though one spouse had passed away. Generally, it is the most advantageous filing status. So most of the credits and various benefits that taxpayers can get from the IRS or from the government works best for married couples. And as they separate and start married filing separate, as we're going to see in the next slide, we're going to see that they don't do as well with the credits and the various benefits. So that's married filing jointly. Is married filing separately. Married couples that file separately have to be considered married on the last day of the year, as it would be with married filing jointly. Includes common law marriages as well, just like married filing jointly. Each spouse files their own separate tax return. Spouse's name and social security number must be entered on their return. So if you file a married filing separate return, you need to put your spouse's social security number and name on that tax return as well. And oftentimes what I've found is that people that have separated oftentimes don't know their spouse's social security number. In some cases, they're still on speaking terms and they are able to get that. But in many cases, they're not on speaking terms, and so they basically do not have their spouse's social security number. So if the social security number is unknown in our software, TaxSlayer, you can enter a Social Security number of 111001111, and that allows you to continue in TaxSlayer. However, the tax return will have to be mailed in USPS and will not be able to be e-filed. So what are the disadvantages to using the married filing separate filing status? MFS has a higher tax rate overall, which is actually equivalent to the single taxpayer tax rate and not equivalent to the married taxpayer. So the married filing separate taxpayer pays a higher overall tax rate when they file separately. 85% of Social Security benefits can be taxed if the taxpayer lived with the spouse at any time during the year. So in a married situation, many taxpayers, unless they have additional income, if they only have Social Security, many taxpayers don't pay any tax at all on their Social Security. But when filing separately, they could get stuck with the 85% tax, 85% of their Social Security income being taxed. Most tax credits are disallowed when filing MFS. Things like education credits and credit for the elderly or disabled are disallowed when you file MFS. Taxpayer cannot deduct student loan interest. I had a taxpayer a few years ago that was married but had to file separately because her spouse had a business and he was way behind on his taxes for his business. So if they filed jointly, she would get stuck having to pay the penalties on what he was behind on in his taxes. So she chose to file separately, but unfortunately, she had studied to become a lawyer and had paid lots of student loan interest over the years, and she was unable to deduct her student loan interest on the front page of her tax return. And her student loan interest was, $2,000 or more dollars that she paid each year, and so she got a pretty significant reduction in her taxes if she was able to claim that student loan interest. But because of the MFS situation, she was unable to take that deduction. Another problem with MFS is that if the spouse itemizes their deductions, and this is common because oftentimes when a couple splits up, the one of the spouses gets to keep the house, and of course the house has a lot of deductions that can be taken on their itemized deduction Schedule A. So if you have one spouse that takes these deductions for the house on their Schedule A, such as mortgage interest, real estate taxes, that kind of thing, the other spouse must also itemize the deductions. And oftentimes that other spouse has no deductions that they're able to itemize, so they really don't get any benefit at all from that, and they end up getting hurt by it. So in some cases, if you have two people that are on speaking terms and are still able to work things out between them, they can agree to either itemize or not itemize as a couple. But oftentimes these couples are not on speaking terms. And if one person itemizes, the other will probably file a return not itemizing, but then they'll get a letter from the IRS saying your spouse itemized, so you have to itemize. So they will have to amend their tax return and make sure that it coincides with what the spouse did. So it gets a little messy. Why do some married couples choose to file separately? Well, because perhaps they just want to keep their finances separate. I have a client that filed jointly, but their lives were so complicated, and one of them had a much more complicated life with a lot of rental property than the other. And so in the final analysis, they decided to split up their tax returns and do them separately because one had a much more straightforward tax return, but the other had a very complex one. So it just ended up being better to have them file separately. And they really, because they didn't qualify for any credits anyway, they really didn't lose a whole lot by doing it. A spouse has already filed MFS. Well, okay, couples that have split up do find that the other spouse has already filed MFS or has filed head of household. And so the remaining spouse who hasn't filed yet ends up having to file, filing separate because they don't really have a choice. Married but separated and not filing MFJ. So the couple has split up and they have chosen to file separately for that reason. But here's probably the biggest one, and this is the one I referred to in the last slide. There's no liability for the spouse's tax obligations. So if one spouse has a small business and has been not paying their taxes, or they're behind on their taxes, the other spouse typically doesn't want to be involved in that obligation, so they file separately for that reason. A couple of other reasons why a married couple might want to file separately. Sometimes you will find that the married couple actually has a lower combined tax when they file separately. It doesn't happen often, but it does sometimes happen. So especially if they have health insurance through the ACA, which often called Obamacare as well, they may have a lower repayment of the advanced premium tax credits that they received for their health insurance. So they may have to pay back less if they file separately. And sometimes there's a lower combined tax because one spouse has high medical expenses, and those high medical expenses end up benefiting that one spouse more than they would benefit, more than the expenses would benefit the couple as on a joint return. Refund is not offset by spouse's outstanding tax or other debts. So one of the spouses may in fact qualify for a refund, yet the other spouse has a significant balance due at the end. Well, the one spouse with the refund would like very much to get their refund and not have to sacrifice their refund because their other spouse owes money. So if they file separately, the one spouse with the refund gets the refund and the other spouse ends up paying. So that's about it on reasons to actually file separately. Now we're going to talk about head of household filing status. We're going to talk about it in two different ways. We're going to talk about unmarried people that file head of household, and we're also then going to talk about married people that file head of household. So they handle it a little differently. So on the unmarried side, a taxpayer that provided over half the cost of maintaining the home for a qualifying individual would be able to use the head of household filing status. Generally, it is dependents, including dependent parents, that can be used for the head of household filing status, even if those dependent parents don't live with you. For instance, if you have a dependent parent that's confined to a nursing home or that kind of a thing, but they're still considered dependents of yours because you support them, you help them in so many ways. That's really kind of the only situation where you can have a parent be a dependent of yours and not have them living with you. Other relatives would not qualify as a dependent if they were in that sort of a situation. So it's really, it's a situation that's reserved strictly for parents that are confined to nursing homes and uh, other living arrangements as well away from your home. Non-dependent blood relatives that lived with the taxpayer during the year generally don't qualify. However, there are some situations where they might, and the best thing for you to do is to consult your qualifying child, qualifying relative resource tool. Go to page 8 for filing status and go through that filing status graph or chart to determine whether someone would qualify for head of household filing status. You can also look at page B15, B as in Brian 15, in the publication 4012, and that gives you a pretty good feel for who qualifies the taxpayer for filing using that filing status. So now we're going to move on to the married filing status, married head of household. What are some of the advantages to filing head of household? Well, you have the higher standard deduction than single or MFS. So a higher standard deduction, that's an incentive right there. And you have an advantageous tax rate structure. So the tax rate is better on head of household than it is on others, on the other filing statuses. Higher phase-out thresholds for some credits. And you may ask, well, what in the world is a phase-out threshold? Well, generally for credits, the taxpayers qualify for credits if their income is within a certain range. But if a taxpayer has income that's extremely high, or sometimes not even extremely, if it's just above a certain threshold, they no longer qualify for a particular credit. Or they may be in what's called a phase-out range, where they qualify for the credit, but they don't qualify for all of the credit because they're in that phase-out range. And then when they get to the top of the phase-out range, their income is at the top of the phase-out range, they're completely phased out. They don't get it at all. So that's how phase-out works. And you can see that head of household has higher phase-out ranges, higher phase-out thresholds than single or married filing separate. Education credits are available when filing head of household, but they're not available when filing MFS. So head of household gives the taxpayer the ability to use education credits, which can be very beneficial. Education credits can amount to quite a lot of money. So if you can possibly qualify for education credits, you should, and by filing MFS, you wouldn't. Next filing status we're going to talk about is the qualifying surviving spouse, which previously was called qualifying widow or widower. So they changed the name of this. They didn't really change any of the rules associated with it. So anything that you may read prior to it being called QSS, it all works the same way. So let's talk a little bit about the details. The taxpayer must have been entitled to file married filing jointly in the year of the spouse's death. The taxpayer must have a dependent child living in the home all year, but that excludes grandchildren. Grandchildren do not qualify the taxpayer for using QSS as a filing status. The taxpayer must have paid over half the cost of keeping up the home for this dependent child. Qualified surviving spouse filing status is eligible for 2 years following the year of death. So only 2 years they are able to use this QSS filing status after the year of death. The year of death, they would be married filing jointly, but after that, as long as they have that qualifying dependent child, then they can file qualifying surviving spouse. The advantages are basically that standard deduction is the same as married filing jointly. So even though a taxpayer may have lost their spouse, they still have 2 years of being able to file with that larger standard deduction for married filing jointly. They also get to use the married filing jointly tax rates. So the QSS and the MFJ tax rates are the same. So the next slide talks a little bit more about QSS. A little more on the qualifying surviving spouse. To qualify for the QSS filing status, the child must be a dependent, or these situations that follow. Child would have been a dependent except their gross income was above the threshold amount of $4,700 for tax year 2024. That, by the way, is the same number that's used to determine whether somebody qualifies a taxpayer for using the head of household filing status. So that's the magic number for 2024, $4,700. So a person could have income higher than that $4,700, but they still qualify this taxpayer for filing QSS because they've lost their spouse. Also, the child may have married filing jointly, so it's an older child that may qualify the taxpayer for being able to claim QSS. And oftentimes, children that are older children that are permanently disabled will qualify the taxpayer for using the QSS filing status because they're being cared for by the older parent who may have lost their spouse. Taxpayer is a dependent of someone else and therefore cannot have a dependent child. So even though the taxpayer is a dependent of someone else, they cannot have a dependent child, but they can still qualify the taxpayer for the qualifying surviving spouse. So there's also another note here that an adult child that moves back with a widowed parent, a parent who's lost their spouse, can qualify the taxpayer for QSS status even if they have gross income of their own, as long as all other requirements are met. So that's about it on QSS. And again, the qualifying relative resource tool is the best way to determine. And also keep in mind, you want to look at those footnotes because that can make a difference. So use that tool to determine whether somebody qualifies to QSS. A little note here about filing status within TaxSlayer when you're actually doing tax returns using TaxSlayer. You have to be aware that changing the filing status while you're doing a TaxSlayer tax return deletes the existing Massachusetts tax return. So if you do change the filing status, the Massachusetts tax return is going to disappear and you're going to have to recreate it. So that's just a little heads up on what happens when you change filing status in the software. Let's look at a couple of scenarios and actually go through the process of determining filing status using the resource tool, the qualifying relative resource tool that you all have. So here's the first scenario. Mr. Buck provides total support for his 2 young children. His wife died in 2018 and he has not remarried. What is the best filing status for Mr. Buck? So if we go to the next slide. So this is the qualifying relative resource tool, page 8, the absolute last page of the resource tool. And you can see here that it's basically a flow chart that you would go through to come up with the final resolution for what the filing status should be for Mr. Buck. So let's start at the top. Were you married on the last day of the year? And the answer to that is no, because his spouse died in 2018. So we go to block number 2, and actually the block numbers are marked in red. So we go from block 1 to block 3. Did your spouse die during the year? The answer is no, she died in 2018. So we go down to the larger block, which has 4 bullets in it. Do all of the following apply? So all 4 bullets would have to apply in order for you to say yes to block number 5. So your first bullet in that block is your spouse died in one of the 2 years prior to the tax year and you did not remarry before the end of the year. And obviously that's not correct. So those 4 bullets all need to be a yes in order for you to go to block number 6. So you're not going to go block number 6. You're going to go straight down to the last block, block number 8. Do both of the following apply? You paid more than half the cost of keeping up the home for the required period of time. And the second bullet is you have a qualifying person for head of household as defined in the accompanying charts. Notice the superscripts 2 and 3. You would normally look at the footnotes for those to make sure that there isn't something else that comes into play here.
I've already looked at those footnotes, so I know that there is nothing that's going to interfere with this. So the answer to that bottom block is yes, and that brings you over to block number 10, head of household. So head of household is Mr. Buck's best choice for filing status. What if his wife died in 2022?
So here again, we're talking about tax year 2022. Were you married on the last day of the year? That's 2022, and the answer is no. Did your spouse die during 2022? The answer no. And then we get to the block again, where there are 4 bullets, and this time all 4 bullets are they actually do apply. Your spouse died in one of the 2 years prior to the tax year. She died in 2020, so that is one of those 2 years. In the year of death, were you entitled to file a joint return with your spouse? The answer to that is yes. You paid more than 1/2 the cost of keeping up your home for the required period of time. The answer is yes. And your child or stepchild who was your dependent or could have been your dependent lived in your home for all year. A foster child or grandchild does not meet the test. And the answer to that was yes as well. So here you can see that qualifying surviving spouse is the appropriate filing status for Mr. Buck in this scenario. So that works out well for him in 2022. Scenario number 2 for filing status. Jane is 69 years old, whose husband died July 1st of the current tax year. She had a $20,000 pension and a $15,000 Social Security income during the year. Jane's 10-year-old grandson lived with her all year and is her dependent. Jane provided all the cost of maintaining the home for her grandson for the entire year. What is Jane's most advantageous filing status?
Well, this one's pretty easy. So if you start at the top of the chart, were you married on the last day of the year? The answer is no, because the spouse had passed away. And then we go to block number 3. Did your spouse die during the year? The answer to that is yes. So without going any further, without having to even think about the grandson, immediately we discover that Jane qualifies as married filing jointly or married filing separately, but most likely she's going to file jointly for the current tax year.
Assuming that nothing changes, what filing status should Jane use next year? Well, this one's a little more involved. So we start at the top. Were you married on the last day of the year? The answer is no. Did your spouse die during the year? The answer is no. And then do all the following apply? So you got 4 bullets. The first 3 bullets do apply, but the last one, your child or stepchild who was your dependent or could have been your dependent lived in your home all year. And then look in the parentheses, it says a foster child or grandchild does not meet the test. So you have to answer no, because all 4 of those bullets did not apply. So we move on to the last box at the bottom, box number 8. Do both of the following apply? You paid more than half the cost of keeping up your home for the required period of time. Yes, that does apply. The second bullet, however, you have a qualifying person for head of household as defined in the accompanying charts. Yes, that does apply as well. And that's really the key. You have a qualifying person for head of household as defined in the accompanying charts. So here you have to leave actually the filing status decision tree, and you have to go to the qualifying child, qualifying relative charts, and you have to use those decision trees to establish that bullet number 2 also applies. Since it does, that means head of household is the filing status that she would use for the following year.